With treasuries paying 5%, there's not that much motivation to risk your capital on a stock that's also paying 5% or even 6%. But at 10% and a history of growing their dividends that spans almost 2 decades, well... I first reviewed Ares Capital in January 2023. After reviewing their last earnings report, spoiler alert, I have no plans to sell it. Today, I'll briefly cover a few of the reasons I bought it in the first place, but mostly I'll update you on how they've been doing since that review in January. Here are the dividends going back to 2004. The spikes are all special dividends. The regular dividend has only been cut once, and that was the result of the 2008 global financial crisis. The cut was 16.6%, which isn't really that disastrous compared to what was happening at the time. Other than that, the dividend has steadily grown over the years from 38 cents per quarter to 48 cents per quarter. That dividend growth means that the yield on cost is rising above 10%, meaning if you purchased ARCC, say, 3 years ago, your yield on cost would now be 13.43%. My original review mentioned a 2.5% cut in 2020, but after going back through the data recently, that was an error. There was no cut during the pandemic. I believe the error was caused by a special dividend being included in the regular dividend one quarter and not the next. No big deal. Compared to other BDCs, the regular and special dividends are less than average. Usually they're around 10% or high nines. The lower chart shows slightly higher yields because it includes special dividends. Ares pays out less because it's more conservative with its cash, which we'll get to shortly. A quick disclaimer, I'm not a financial advisor, so I won't say things like, you should buy this, because that's up to you. Since retiring in 2017, I began researching my investments in far greater depth because now they pay for everything. When I find something interesting, I make a video. Ares Capital Corporation, ticker symbol ARCC, is a business development company, or BDC. That's a category of private lending that's required to pay 90% of their net investment income as dividends to investors, much like a REIT. The January review goes into more detail about this investment category and the Ares business model. Given the high percentage payouts, most of the return for BDCs comes in the form of income, not appreciation. So BDCs are generally more popular with retirees. To give you some context, over the long term, this price chart shows that the S&P 500 gets most of its returns from appreciation, while ARCC's price is relatively flat by comparison. Then, when you include the dividends to show the total return, they're pretty close at 197 versus 192%. There are about 50 BDCs and their performance and risk vary considerably. Of those, I estimate about 10 are worth considering. I've reviewed 5 on this channel and ARCC is one of my favorites. The key differentiator for ARCC is its size. Whether you measure by market cap or assets, it's the dominant player, king of the jungle. It's the apex predator. I've been watching a lot of nature documentaries lately. The key benefits to ARCC's size are access to debt at lower cost, or better terms, or both, and secondly, a more diversified loan book. The median number of borrowers for a BDC is about 130, according to Systematic Income Investing. ARCC currently has loans out to 490 companies. This spreads out their risk, and a default by any individual borrower doesn't break the bank, or in this case, the BDC. Let's move on to what's happened since that January review. ARCC generates profit or earnings by raising debt or issuing shares or borrowing money. Then they lend out that capital at higher rates over shorter terms. You can see here the difference between what it costs them to borrow money in red versus the rates they lend out at in blue. As interest rates have increased, the gap between the two has expanded, causing profits to increase. Interest rates will probably top out soon if they haven't already, so profits won't keep expanding at this pace. On the other hand, when interest rates fall again, the demand for loans will increase, which increases loan volume. In other words, as long as they manage the risk well, BDCs can do well in low interest or high interest rate environments. Speaking of risk, the loan default rate is measured by non-accruals, or payments that are 90 days overdue. As interest rates rise, the non-accrual rate is expected to rise too. But ARCC's non-accrual rate is below average and it's actually falling. It's an indicator of how well they underwrite their loans, but it's still something to keep an eye on going into 2024 because next year apparently there's going to be a recession. Although it was supposed to happen this year, so who knows. Rising interest rates eventually affect ARCC's interest expense, but they have it under control. They'll only be refinancing a relatively small proportion of their debt in 2024, so their average interest expense will only increase slightly. One of the things I like most about ARCC is their conservative use of cash. Eventually, they'll pay out 90% of net income, like I said at the beginning, but they keep some in reserve for a rainy day. The current distribution is 48 cents per quarter, and it's fully covered by earnings, but they have an additional reserve up their sleeve. The exact number isn't published to the end of the year, but based on reports from the REIT Forum, Systematic Income Investing, and the CFO's comments during the earnings call, it's going to be at least $1.18, and that's one of the highest in the sector. By the way, the CFO's name is Penny Roll. That's got to be the best name for a CFO I've ever heard. Can you imagine how many watching the pennies jokes she must get around the office? Moving right along, I have a lot of respect for Scott Kennedy's extremely detailed financial analysis of BDCs. Here's a quote from his report on 2023 Q3 earnings. And I should preface this by saying he's very conservative with his praise, so this is almost a love letter in his language. Regarding ARCC's dividend, management, the board of directors, continued to be very cautious regarding payouts for the fourth quarter of 2023. ARCC declared an unchanged 48-cent per share dividend and no special periodic dividend. This is simply management being very cautious in case recessionary risk rises over the foreseeable future. There is extremely little risk ARCC needs to reduce the company's current quarterly dividend per share rate through at least the first half of 2024. This even considers the bearish case. A mild to modest recession is on the horizon. Very important to understand. ARCC continues to have a very large cumulative undistributed taxable income balance. I'll just pause for a sec. UTI isn't something you go to the doctor about. It's the rainy day fund. Let's get back to the quote. This figure is estimated to be $766 million, or a ratio of 1.35 as of September 30, 2023. Likely will continue to be the largest out of the 15 BDC peers we cover. This very important and positive catalyst is one of the main reasons I own this particular BDC stock. That's high praise from Scott. And the last update is regarding how ARCC secures its loans. The best position for a lender is first lien. That means they're first in line in a bankruptcy, and that the loan is secured by collateral like real estate or trucks, machinery, something like that. 43% of ARCC's loans are first lien, which is about half the average for other BDCs. If ARCC wasn't the largest BDC with a 19-year track record, that would be a concern. But if you're good at underwriting, bankruptcies are less of an issue. The update is that their loan activity in the past 2 quarters has been more concentrated on first lien loans, 70% per quarter. And the first part of October was 97%. So that's a positive trend for risk management. The best BDCs tend to be more expensive as measured by their price to book ratio. That includes some of the BDCs I've covered on this channel, like Hercules, Southwest Capital, and Main Street. Compared to these other high-quality BDCs, ARCC is currently, I'd say, reasonably priced. Scott Kennedy, who I quoted a minute ago, rates ARCC as a buy when it's below 1.05 times book value. And as I record this, it's 1.03 times book value, which is not bad. I'll include links to Scott's most recent ARCC analysis on Seeking Alpha, but he mostly writes on a separate paid service called the REIT Forum. Seeking Alpha is my primary source of information for all stocks and funds. That's why I keep talking about them. If you haven't yet taken it for a test drive, I'll include a link for a free trial and any promotions they're currently offering. I'll also put a link to the REIT Forum in the description, but just to warn you, it's almost 5 times the price of Seeking Alpha. It's for investors who want to go really deep on BDCs, REITs, and preferred stocks. I mean, really deep. If interest rates remain level in 2024, ARCC's margins are great. If interest rates fall, ARCC's margins go down slightly, and demand for loans goes up. I'll keep an eye on the default rate, but generally I remain comfortable in management's ability to continue its consistent performance, whatever happens to rates. I bought ARCC back in January of 2023 when I did that review. It's about 3% of my portfolio, and I'm open to buying more on dips. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you time, and yes, ARCC is on that list. That wraps it up for this ARCC update. More armchair income coming soon.